Ever feel frustrated when thinking about retirement? Food seems to be more expensive. Rent is getting higher and higher. Without a paycheck, how can we live off comfortably? But what if I told you that just $10 a day could snowball into a portfolio that pays you $14,000 every single month in retirement? It's much easier than you think if you know this secret strategy we are about to reveal. Here's the game plan. First, I'll show you what dividends really mean, no jargon. Then, the simple checklist that separates real retirement-ready funds from the fakes. And stay tuned, because hidden in Fidelity's lineup is one dividend ETF that beats the fan favorites. Finally, we'll crunch the numbers so you see exactly how $10 a day can grow into $14,000 a month. Let's jump in. So what exactly are dividends? Think of them as a company's way of saying, "Thanks for trusting us. Here's your share of the profits." It's real cash, usually paid every quarter, or even monthly if you pick the right ETF. You can spend it, reinvest it, or stash it for later. But here's the real magic: compounding. Reinvest those payouts and they buy you more shares. More shares create more dividends, and the cycle repeats, snowballing into something massive over time. Forget Einstein's quote. You'll see why investors call it the eighth wonder when your portfolio starts growing without you lifting a finger. Let's put numbers on it. Just $10 a day, about $300 a month. Doesn't sound huge now, but as those dividends reinvest, you're stacking new income-producing shares every month. Fast forward a few decades, and that small daily habit can turn into serious retirement income. And here's why it's different from growth stocks. With dividends, you don't have to sell shares to get cash. They pay you simply for holding. That flexibility is the key to financial freedom. Now, not all dividend funds are created equal, and that's why Fidelity's Hidden Gem ETF matters. It's easy to get lured by flashy funds promising 12% or 15% yields. But if that payout collapses or your portfolio tanks, you've just sabotaged your retirement. That's why you need a filter, and there are 3 criteria that separate real retirement-ready funds from the traps. First, yield you can feel. Dividends have to be meaningful. A fund paying 1 to 2% isn't enough to live on. But here's the catch. Sky-high yields, 12%, 15%, are usually too good to be true. That's called a dividend trap. The sweet spot for most ETFs is in that 3 to 6% range, strong enough to matter, safe enough to last. Second, payments you can trust. Yield today means nothing if it dries up tomorrow. The best ETFs own companies with stable cash flow and a history of raising dividends. That's how you fight inflation, because what good is $500 a month now if in 20 years it barely buys groceries? Third, growth you can ride. Too many people stop at the dividend check, but the value of the ETF itself matters. You want funds backed by companies that grow earnings, expand market share, and push stock prices higher. The bigger your portfolio grows, the bigger your income base becomes. Put it all together: yield you can feel, payments you can trust, and growth you can ride, and you've got the recipe for a retirement-ready dividend ETF. And guess what? Fidelity has one that checks every box. FDVV. So let's get practical. If you wanted to keep things simple with one fund, Fidelity's High Dividend ETF, ticker FDVV, is a serious contender. It tracks the Fidelity High Dividend Index, giving you exposure to large U.S. companies that pay strong dividends and have the muscle to keep raising them. What makes FDVV stand out? It doesn't just chase the highest payouts, it screens for quality, companies that can sustain and grow their dividends. And unlike most dividend ETFs, FDVV leans heavier into tech with names like Microsoft, Apple, and Broadcom, while still balancing healthcare, finance, and consumer stocks. Translation? You're not just getting income, you're getting growth drivers too. Now here's the catch. FDVV overlaps a lot with the S&P 500. When the market rises, FDVV rises. When it falls, FDVV falls too. This isn't a hedge, it's a growth and dividend ride, with payouts softening the bumps. And of course, We can't ignore SCHD, the king of dividend ETFs. Low fees, huge popularity, and very reliable payouts. But let's test them against the 3 criteria we covered earlier. Yield. SCHD pays about 3.7% today, a touch higher than FDVV's 3.2%. Advantage. SCHD. Dividend growth. FDVV's dividends have grown 16% a year, almost double SCHD's 8%. Share price growth. FDVV has compounded at 14.2% annually, compared to SCHD's 8.5%. Big edge, FDVV. And here's the shocker. Over the last 5 years, FDVV's total return is up 126%, topping RDIV at 120%, DIVB at 100%, and leaving SCHD far behind at just 75%. That's not edging out the competition, that's crushing it. To be fair, SCHD wins on cost, 0.06% versus FDVV's 0.16%. But that tiny gap is dwarfed by FDVV's faster dividend growth and stronger returns. Plus, FDVV spreads its bets more evenly. Its top 10 holdings make up 33% of the fund, compared to SCHD's 41%. That lowers concentration risk. So while SCHD gives you a slightly higher yield today, FDVV's growth, balance, and performance make it a powerhouse for long-term wealth. Now, let's run the numbers and see how $10 a day into FDVV can snowball into $14,000 a month. Now let's put this into action and actually build a retirement plan. And here's the best part. You don't need to be rich. Just $10 a day, about the price of coffee and a snack, can set you up for $1 million portfolio. Here's how it looks with FDVV. The fund yields about 3.2%. Its dividends have been growing at 16% a year, and its share price has compounded at over 14% annually. Put those 3 together, and you've got a compounding machine. So what does $10 a day, or $3,650 a year, really do? After 5 years, your $18,000 in contributions could grow to around $26,000, and the dividends alone might cover a phone bill, about $56 a month. Fast forward 10 years, you put in $36,500, but your portfolio could be worth about $85,000, paying you nearly $230 a month. That's a car payment, completely covered by dividends. At 20 years, things really snowball. Your contributions of $73,000 could grow into over $500,000, paying almost $1,900 a month. That's rent, groceries, and then some. And the 30-year milestone? With just $109,500 invested, your portfolio could realistically top $3.4 million. The dividends alone would be life-changing, about $14,000 every month. That's travel, freedom, supporting family, and the peace of never worrying about outliving your money. And remember, that's the power of consistency plus compounding. A small habit today can build the kind of future most people only dream about. And that's it. With FDVV, you don't need complexity, just $10 a day into a high-quality dividend ETF. Yield, growth, and appreciation do the heavy lifting, and compounding does the rest. Over time, that simple habit can unlock true financial freedom. Would you try this $10 a day plan or stick with your own strategy? Let me know in the comments. And if you want more ETF strategies, tap the video on your screen. The next one could change the way you invest.